Hey, and we're live. Welcome to Benny and the Squirrel. Benny's back on the road. He's back in Dubai. So God knows what his body clock's doing right now. We're going to have a quick run through ahead of what is a pretty wild week. We've got NVIDIA earnings. We've got JP Morgan's Investor Day. We've got State of the Union. We've got how the market's going to respond to tariffs. We have got what's going on in Mexico right now, which looks pretty real, but doesn't seem to be moving the FX at all on Sunday Night Open. And I want to talk about gold miners. Why not? Because I've turned into my dad. How you doing, Benny?
Good. Rocking and rolling. Got through the Dubai, customs the fastest of all time. So that was great.
What, just so that you get to a screen to watch the overtime in the hockey, or
I missed it. I missed the overtime by like 15 minutes. It was like I was in the baggage claim. I got through customs and I was listening to a live stream, and they're like, "Goal!" And first time that the U.S. hockey team has won in my lifetime. So exciting game. I wish I could have watched it, but sounds like it lived up to the hype.
Okay, well, listen, I want to just quickly start with a quick plug for the conversation we had with Tom Roderick last Thursday, which is up on the YouTube site. Really bloody fantastic conversation. Now, Tom was worked for Hugh Hendry at Eclectica and now runs his own macro sleeve at a shop in London called Trium Capital. We talked about all sorts of things on Thursday, but we had a particularly interesting conversation about Asian FX. Stop chasing DRAM tech companies in Korea up here. You might have a much safer play in the won. I think it's really worth taking a look at.
You know what's funny about that though is that the EWI was up 5.5% the next day on Friday. Closed the week with a nice 5.5% ripper. I mean, up 46% year to date. Unbelievable.
Yeah, it is pretty incredible. Well, one thing that we were doing was comparing the Korea chart to the silver chart. But before we go there, because we're going to be quite precious metals heavy for this show today, because I wrote a long piece which should be in all of your inboxes right now. If you're not, why you're not a Squirrel subscriber. But I just wanted to start really with where we are in risk, because I have to say, I don't understand why the software refuses to print squirrels in the title, but my whiskers are getting a bit twitchy about risk. And you've got record participation in equity markets by retail right now. You've got all sorts of headline risk knocking around, and I thought this chart was interesting from BAML last week. It looks like everybody's all in.
Yeah, it's weird because I think that there is something to that extent. It really felt like that, from August to September, really felt mania-like. Since then, as we've talked about many times on the show, there's been under the hood dynamics, right? So you're not all in if you're in crypto. You're not all in if you're in software. So there's some groups that have really gotten dirt napped so far. So you're hanging on with the names or the areas we've talked about. And ironically, energy is second best sector. I think it's the best sector, but on my board, EWI. So, but memory and then energy. And, it's not like energy prices are really even that high. So it's actually kind of interesting. Now it shows you the impact of base effects where there was nobody there. So when you go from washed out to just bad, you can get good returns often, right?
What I noticed last week was quite interesting, because my energy names have performed incredibly well. Sorry about that, Bonnie. Have been performed incredibly well, but the one group that didn't participate last week was the refiners. Now, maybe we'll talk about the energy costs generally later, but obviously refiners benefit; their crack spreads improve with a lower oil price. And they've had a pretty good 6 months. I'm just wondering if the slowdown by the refiners is a sign that we may have some higher energy prices to contend with later on. But I mean, back to risk generally. I've now taken my beta portfolio up to almost almost a quarter in cash and hedges. And the title of my start the week note that'll hit inboxes at 7:30 Eastern tomorrow morning is, "Oi, did you spill my pint?" It's a bit of a British thing. It's if it's that drunk in the corner of the pub that accuses you of knocking over his beer. It's usually a sign of trouble ahead, and that's kind of how I see the market looking at me right now. So I have gone pretty defensive. To be honest, it's been a really good start to the year for most of my themes. I'm just thinking, maybe step aside for a little bit.
Yeah, I mean, look, we've talked about it. I mean, I feel as though the market feels very wobbly. I think you have that gigantic equity vol short that we've talked about numerous times on here that could rise with implied correlation. I think you have credit starting to show its head a little bit. And just remember summer of 07 or like spring of 07, spreads were very low. Then you get New Century and the Bear Stearns funds. Then you get the quant apocalypse, which you could consider something similar to like, the software, and you just start to see things, and then it propagates, right? So these things, especially with the liability structure as it is now, which is very different than then, where it's all in the shadow banks. I mean, the problem stuff is clearly the shadow banks, which I know as a guy who owns high yield CDS, which is dramatically not reflecting what you see in the BDCs and the private equity names, which the implied spreads are much, much higher. So, yeah, I think it's there. And I guess as they always say, the risk is in the system. It's just a question of when we take the mark, And so right now you still have the CapEx boom and the hype of that. And you have, a generally complacent marketplace. But it does feel, I mean, as you're saying, you're starting to get a little twitch. You're starting to see people get a little nervous. And I actually have had some inflows into my long ball fund recently from guys who are just trying to add to their hedges. So there's another data point for you.
Well, that is interesting. That is interesting. I mean, I think there is definitely a massive gulf between where retail heads are and where institutional heads are. Now, retail's kind of done relatively pretty. They've been much better dip buyers in the last 18 months. Let's see if they're right this time. But listen, I wanted to switch gear back to gold and gold miners, right? Because I wrote about it this weekend, and importantly, we have got JJ Johnston joining us on the pod on Thursday evening. This is JJ, also known as Alyosha. Now, I think he bought his first seat on the COMEX in 1975. He was trading in the silver pits live during the Hunt Brothers squeeze. He is jam-packed full of stories. He is just a brilliant technician and professor of the futures markets. I'm really looking forward to him, and I'm desperate for him to school me on my thesis around the metals, but right this week specifically the miners. Right, I got out of the precious metal miners in the October correction after a great run, with a view to potentially adding them back once they stabilized. Now, they stabilized really quickly, but I pressed pause, right? And I thought initially we might have to wait for to see if there are any sort of new tax year sellers, right? At the beginning of the year, that might get a better entry point. And then I started to go, well, actually, do I want to do what I did before, which was to just own miner beta through the ETFs, or did I want to do a bit more work? And I went through that process in a long note that hit inboxes on Sunday morning Eastern time. So this is quite a nice long-term chart of the gold bug, the NYSE gold bug index versus spot gold. And if we thought we had a big rally of the miners versus the metals, you could have a view that we're in early foothills here. The next slide, and the chart back will be in inboxes after the show, is the 4 minor ETFs. That's GDX, GDXJ, SIL, and SILJ versus the SLV ETF, the GLD ETF, and SPPP, which is the Sprott PGM physical ETF and just sort of charting my ins and outs and hedges and de-hedges over the year. And I've set out that story in the weekend note. So where does that leave us now? Right, we've talked about gold and silver volatility quite a lot recently on the show, but this is a 5-year chart of it now. These levels of silver vol and gold vol are still at absolute levels pretty high, and so far the gold miners have completely ignored that, and they're just sort of powering on. That's the red line in this chart here. I mean, the question then for you, Ben, is should we still be worried about the underlying metals volatility when thinking about the miners here?
I mean, look, my issue with miners in general is that over time they're far inferior on a risk-adjusted basis. So you got 2.5 to 3 times the volatility of gold, and so the idea would be, why didn't you just own levered gold, right? And so I think that the issue with this is, and I don't think we have it, but I sent it to you, was
we
the
do.
gold.
I'll put it right up. I'll put it up right now. Okay. I know where you're going. Because
okay, so
this is the long-term gold to oil ratios, and then in the chart underneath, sorry, it's a bit of an eye test, but it is just basically gold miner margins for the top 20 producers. Okay.
Yeah, so that's right. That's great. I'm glad you put that. But so Rupert had asked me for a long-term chart of gold to oil, and I have it going back to 1872, but I don't really like to think about it too much pre-peg because gold was managed in price. But if you look at that post-peg, so post-Bretton Woods too, we're at the 100th percentile of gold to oil. So 1 ounce of gold can buy 75 barrels of energy, and I think you guys have all heard me. They're both just kind of stored energy at a primary basis of what they are. That seems extreme. Now, I know Luke Groman and some other guys have argued of why gold to oil ratio could keep running. But I guess my point is for the gold miners and silver miners, basically, to keep working, you need this to stick around this level or continue to expand as those guys, because the gold to oil is basically a proxy for the cost of digging the ground, the metals out of the ground. And then, Rupert's chart on the bottom, which again, it is a little small. You can see gold to oil rising, cash margins rising. And it makes sense if you think about it, because it's like, hey, it's costing me less and I'm getting more top line, and it's all price. So there's no incremental costs to that incremental revenue. So margins expand, cash flow expands, the stocks go up, right? So I guess that us at the 100th percentile which is the chart on the top right, is something to just be aware of, right? So,
I think so. Go on. I think so. My counter to that, and is this was very relevant when we were talking about $1,000 gold, $800 gold, $1,200 gold. In a $5,000 world, the percentage of all-in sustaining cost when it comes to producing gold, and a global average, you've got $1,500. Ultimately, a 20%, 30% even rally in energy prices only hits margins by about 5 or 10%, right? It's not as much of a gut punch as it used to be in the old days.
Yeah, I mean, look, I guess so. You got two things there, right? So I'm normalizing for percentile, which is it's not gonna take advantage or acknowledge the differential, right, between the percentile. Yeah. So now, if you think about gold to oil up here, 99 percentile, 100 percentile could be significantly higher cash flow than the 96 percentile, right? So you got to think about the magnitude, right? So if I was to normalize using standard deviations, it would look more extreme, right?
Yeah.
But I think that's right, and that's why I said if it can just hang around here, so you can just have energy prices stick in this 55 to 72 range, somewhere in there, and gold can hang around in the $4,500 to call it $6,000 range, you're golden, whatever. As long as they're not capital destroyers. Remember, these guys historically, E&Ps and miners, very similar business, right? Your extractive businesses where you get leases and then you sell the metal and you got to heat your home with your furniture type of business. Energy companies, one of the reasons why those stocks are doing well is because they found religion after COVID, and they're much better uses of their cash flow now. Well, better for the shareholders, I should say.
Yeah, I mean,
maybe
I
not.
think so far, it is almost fair to say that of the miners. Now they're yet to be tested with wealth, the temptation of wealth, right? And if you look, and I put together a basket of producing and pre-production miners that which I'm calling shiny acorns, which is the basket that I'm going into here on a gradual basis in response to this vol setup. But across the board, their balance sheets are net cash, and they're forecast to be generating huge amounts of additional cash. And right now, they're not paying out a great deal in terms of buybacks and dividends. I think that comes. And I wanted to show one more chart.
One thing. Yeah, go ahead. I just want to put one caveat on that. I think that what you think about now is, okay, I don't know if this is the time to own Newmont, for example. I'm not sure Newmont is what you want as much as you want, hey, who's going to get incrementally better business? So you dig a little down into it, or you go with the 5 to 20 delta call options, which you call shiny acorns, basically.
Yeah, I have included. Well, let's face it. There are only basically 2 or 3 institutional grade gold miners on the planet, right? In
That's
terms
true.
of large and liquid, and Newmont is the alpha dog. It's the only gold miner in the S&P 500. And I wrote in the note this weekend that I don't think that the real macro allocator flows have come anywhere near the gold miners yet, right? And I poured through the ETF data and the 13F data for Newmont and Agnico Eagle specifically in the weekend note. So I think that you need to have some kind of exposure to what I call insto beta as part of any basket in the miners, because I do think, your old boys at FIDO will rip a bit of Newmont in due course when it starts working for the second year in a row, is my guess. But the other thing I wanted to show, and this is the last chat I've got on the topic, is this is something that the guys at Stifel put together, which hit my inbox yesterday, which I didn't include in the note. It's not my work, but I just want to show it here. If you looked at the last gold peak, right, back in September 2011, right, and showed where the GDX was trading on a price to cash flow basis versus the S&P versus the SPOOs. They were trading at a premium. They're currently, the GDX is at a 43% discount, and that is if we're at a current peak, right? Or the current peak way back then at 50.40. And the other thing about capital discipline, and this is a chart from Sokolov's letter, is that this is tons of production from the LBMA, from the World Gold Council, and it's barely moved in the last 5 years in a pretty rosy price outlook for the metal, right? Not this is capital discipline, or at least beginnings of evidence of capital discipline by the miners, right?
So when I'm looking at this chart, basically what it tells you is the S&P is a lot more expensive than it was back then. So relative, yes, get it. But I would say that almost all the other metrics look somewhat similar to what they did at the peak for the most part, with the exception of it looks like they have better balance sheets now than they did then.
Much better balance sheets.
So, and a better balance sheet, let's be clear, a better balance sheet means better multiples. Like when you go from high yield to IG, there's a big multiple re-rating in that, for example. And I do agree with you. I will take that back a little. I'll walk that back a little on Newmont, that going back to the Mike Green thing of like, there's institutional flows, you get the S&P, blah, blah, blah. But it can work in both ways too. When you look at this S&P being very high, it can also hurt you in that, right? Because I know, for example, to tie this up with energy, I'm a big energy transfer holder, which is an MLP. And one of the beauties of holding MLPs is they are not in the S&P 500, unlike, Williams, for example, which is, when C Corp is. And you can notice in the flows that there's a much high correlation to the S&P, because the people who trade MLPs, you don't sell much because of the tax implications of it. But B, it's like, you don't get swung around as much. So yes, you get the ups, but you also get a little bit of the downs. That's the only thing I would say.
Yeah. So if my premise is correct and they're not in yet, the ups are still in front of us, right?
Right.
That's, I
So
guess,
let me
what
ask
I'm
you.
saying.
So I'm looking at Newmont right now. It's like 5.5% free cash flow yield trailing 12 months, more like 7.5-ish, 8 if you annualize the last quarter, which is probably more relevant because that's gold was whatever sub 3,000 a year ago, right? And or around 3,000. And so now you kind of have to with this start looking at it on not the what the economics were, but like what the cash margins are for here and what you expect. So like if you say, okay, how much cash do I make with a $5,000 gold and assuming, margins stay roughly where they were, and then okay, what are they going to do with the cash? I mean, I think that's what it kind of comes down to. Like if they're going to just go drill for more stuff, but if they're going to
Yeah,
start doing
I
buybacks and
think
stuff in
you get plenty of warning about misbehavior, right?
yeah, no, I'm just
When you
giving
think
people a
about
warning
when you
that,
think
that
about the
that's what you
shale,
want to.
when you think about energy and the shale boom, right? That early 2000s sort of mania in the Permian and elsewhere, there wasn't a hint of supply discipline or in capex discipline anywhere, and Wall Street was fully behind it. You were buying follow-on offerings for the for the drillers every day on the desk. Um, I think we're in a very different world. I mean, basically, all of these management teams have been schooled by near-death experiences from the past. And then getting back to the theme that we've been touching on a lot recently around the general sort of hunger games for capital, right? There's not a huge amount of capital that's going to be given to them, right?
Right. Although I will say this, I was on the phone with a guy who's from Vancouver, who's been around the game a long time, who's involved, made a lot of money in mining stocks. And I remember I talked to him once or twice a year, and he calls me whenever he wants to talk about markets, basically. And I had sent him that 100 percentile chart. And he called me like in the middle of the night, like wanted to talk. The guy lives in Asia, and he did say this: the junior miners 2 years ago, no bid. There's no capital for them, and right now they're raising 60 million, 100 million. Like people are putting money into it. So I will say that remember, if you look at a chart of the 70s when the gold, you had the first really good gold silver. What you don't see as often, and you could just Google it, like go to the World Gold Council, the amount of ounces started ripping. And then everyone wants to talk about Volcker ended it, but the reality was the supply side. So we're still early days, I think, on
Yeah.
that. But it is what
But
Rupert said last week about the guys who end the China thing are guys like Rupert who bring the supply. And so supply of paper is easier to bring on than supply of gold. But that's one thing I just keep an eye on, I guess.
and to that precise point, right? The guy that sent me the charts that I showed you with the multiples, right? I'm on his general distribution list. I reckon that brokerage launched half a dozen equity placements last week for gold companies, right, in Toronto. So, the supply is coming, but if you can get positioned in a close to production asset, which is fully funded through to cash flow, right, that's where the sweet spot is right now. And I think you want your insto beta, you want the sort of semi-institutional names, and you want a bit of sex and violence, for want of a better word, in the pre-production part of the spectrum.
Yeah, to go back to what I was saying, I think about it. If you think about them like options, because there's lots of volatility. Okay, so you have the vol in them right now, so they're elevated. But here's the thing: you want to go one of two ways. You want to go like stuff that's like gonna gain delta, so you're gonna gain more as it goes. So that's why I'm saying the shiny acorns or the 5 to 25 deltas, where hey, you know what, gold can do whatever, but they're going to get closer to production. Multiples rise, more money flows in. Like, again, if you go from just some piece of shit, Toronto Exchange stock that no one cares about to, hey, we're producing gold, we got 8 million ounces. And then, I mean, these stocks can go from $2 to $10 fast, right?
Yeah.
So if you think about it like as a basket approach of like, yeah, maybe I'll own some of this liquid beta and then I'll own some of this to juice it. I think that's the way I would approach it. To be honest, like,
Well, from your lips to God's ears, that's exactly the way Shiny Acorns is put together, Benny. Anyway, listen, you've got to bury yourself and immerse yourself in AI again today. Anything else you want to cover before we wrap?
I think that just to finish it off with gold and silver is, I will say, last week, which was Asia was out, right? You had gold and silver down, but you really had silver down at 72, 73. And I'm looking right now, we're at 87. And that's kind of like around the levels where after the crash in January, last time I was in Dubai, ironically, we got down and then it retested these levels. So I think these are key levels to watch. The chart looks more constructive now. It looks kind of like we had a month of jacking around, and we'll see what happens at the follow through. But it's up $15 in a week, so it's been a nice little bounce.
Yeah, get practicing those press ups. All right, guys.
I think Nvidia this week. If we think about Nvidia, is always a big earnings, and it's always kind of weird because there's all this option into it and stuff. And then remember last time they printed it, everyone was like, oh, because the market was weak then, and like, oh, if market's going to rally, and then the next day just absolute rollover. But ironically, that rollover and then the next day were the bottom before this rally from November 20th to, I don't know, I guess around now. I mean, not for everybody, but so I think that's the big event of the week. We'll see what goes on with all this tariff and Mexico, and I'm over here in the Middle East. So I'm hoping that we can skip out on a war for another week before I leave. Cross your fingers for Benny, all you guys.
Yeah, he's doing God's work for us, going into war zones in the line of duty.
Second time this year, because remember I was in Colombia when they abducted Maduro. So maybe I'm the indicator that if I'm in the region, maybe something happens.
Benny the Black Cat. All right, guys, Benny and the Squirrel out. We'll see you Thursday with JJ.
Thanks, guys.